Hi. Yeah, hi everyone. The topic of discussion is we have a very eminent panelist here. The issue is the challenges that companies face in raising money. So fundraising, of course, is one of the key issues that every corporate face at every level. Traditionally, you had, the only option was debt financing, wherein the companies traditionally used to go to a banks for raising money. But last over a few years, you've seen a complete explosion in terms of where the options in terms of debt financing, apart from banks, you have options like mutual funds, pension funds, or NBFCs. In equity, you have a whole list of, private equity, VC fund. So the avenues for raising money or fundraising for companies at every level, it may be a startup or maybe the large established corporates, have immensely increased. But we still see that, despite there being so many avenues for companies to raise money, there is a large challenges being faced by every company. Most of our companies still find it very, very challenging to raise money. So here we have a very eminent list of panelists to whom I throw open the first question. What is in their experience the reasons why the companies are still finding it very challenging to raise money? Over to you, Stan.
So let me introduce myself. Let me just at least give you a context of what I do, and therefore you can hold those comments in that
Yeah.
context. So I advise entrepreneurs of early stage to mid-sized companies for growth, and naturally in the process of growth, what I've realized is one of the key things that they tend to ask for is advice on raising capital. And when you are a young company with free cash flows not being there, raising debt is always a challenge. And therefore, you want to raise equity on the power of the idea, the power of the team, and the revenue streams, since you're still aiming for financial liberation at the bottom line. What I have experienced, Sumesh, and the audience over here, and we'll of course have questions later on, is the funding uh, supply market has become vast, but has become increasingly complex for entrepreneurs and founders of companies. Very often, you're so busy running a company, you don't even know where to start from. As in, if you're looking for, let's say, $1 million to start with, ranging up to $5 million, not every private equity or VC fund is doing a deal size of that amount. So, which is the select group of investors that you need to approach? Who is interested in your sector? Who is not? Is there a swamber of the sorts? This is a term that I use where in other events organized where, let's say, founders of healthcare companies can come in at one spot and present to a group of investors who are interested in investing in healthcare companies up to $5 million. Those kind of forums and platforms which make the whole thing very organized and not so time consuming, they don't exist today. And then, the whole race starts. You're running out of cash when you're running a company, but at the same time, you have to devote time to your operations. You have to devote time, with the bankers. Investment bankers don't want to take up deal sizes which are less than a certain, less than a certain amount because it doesn't pay for their costs. How investment bankers work. There is an upfront fee and then there is a success fee. So virtually everything is being paid for at the success, which is towards the end. This may take up to 6 months. So for the promoters and founders of companies who are looking for capital, while capital has become available, there almost seems to be a demand for somebody who can help them through it.
Quite
So that's one of my biggest, overall.
biggest. So Mr. Singh, Mr. Sarabjot Singh is from Hannover, from he obviously gives a perspective from an insurance viewpoint. So what do you think, are the key takers or challenges the companies are facing while raising money? Yeah.
When I speak about fundraising, I speak both from a insurance industry perspective
Yeah.
and also from my personal perspective. In my career stint, between 2008 and 10, I became an entrepreneur, and that was by a choice rather than a default, by a design. And I ventured into an insurance broking business in the UK, and that's when I realized how tough fundraising is really from a personal perspective. I wanted to set up an aggregator, insurance aggregator in the UK market, and I did the usual trips to the British Venture Capital Association, BVCA, the Indian Venture Capital Association, Angel Networks, and made some presentations and elevator pitches to these so-called private equity players and angel investors, and I realized that it's a dead end. Seed capital is where the problem lies. Growth capital is easy to come by. And seed capital typically will come from people you know. My perspective is if you need capital, look around you. People trust you, they believe you, and they will probably bank on the ideas you have. It is very difficult raising seed capital from strangers, and this is what my realization was.
So Mr. Parvesh Kheterpal is from Lanco. So you obviously being part of a large infra company, what challenges you feel are the key issues, especially for infra companies? Despite infra companies, being very robust and growing at a very fast pace, but I understand infra companies are obviously facing quite a cash crunch and issues in raising money.
Yeah, in fact, it's a big challenge for infrastructure today. We find in the industry like company like us, which have a big debt on its balance sheet. So if we think to do the new business, it's tough for us because the funds are not available in the market. And secondly, to complete our existing things is a challenge for us because banks are not supporting nowadays to these kind of companies. And no doubt, it was a big expansion by these companies like us, and now we are facing a challenge that getting the funds from the market is a tough. Coming on the other side, where government is very bullish on the infrastructure, like they are promoting the infrastructure. When 2 years back, more than 2 years back, this new government came, everyone was looking forward that they will come with new policies which will give some relief to these infrastructure which are facing a big challenge in the market, like unable to complete the project, funds are not there in the market. When the time came, then banks start stopping these stopping these companies because of RBI mandate. They have started taking the hit on their balance sheet because of provisioning of these NPAs and all those. So that again a big challenge for us to get the money in the market. Where government is, if specifically I cover on the renewable side, because from last 4 5 years I worked on the renewable sector. On the renewable sector, we have seen that government is very bullish on renewable. They have fixed the target of 100 gigawatt by 2022 for solar sector only, and more than 75 megawatt for the wind sector. So it's cumulative 175 megawatt for renewable energy by 2022, where it was 15 gigawatt only for when the previous UPA government has fixed for till 2022. Now the question comes, for such kind of big capacity when you are going to install in India, around 6 lakh crores of rupees are required to be invested in these kind of projects. So from where the funds will come? How the investor is not, why the investor is reluctant to invest in these kind of investments? Because there are few government policies where we are not clear either for the existing infrastructure sector or the new infrastructure sectors. The policies are not clear, then there is no road path available for all those companies. In solar sector only, we have seen 2 years back where 2010 projects allocated by government of Gujarat. After 4 years, discoms went to GRC, then APTEL and Supreme Court, challenging the tariff given at that time, because the tariff calculated at that time was not right. The person who has invested 4 years back based on some assumption cannot go back and say that I have to reduce my IRR. So these government policies, the one point specifically I will cover which needs to be clarified, and better clarity should be there to have the complete road path for these kind of companies.
True. No, well taken. So the next thing, obviously, is we have as a legal counsel, being part of a lot of transactions, we've also faced a new challenge. The challenge is a lot of investors feel, a lot of companies do not have adequate insurance cover. So we have a pleasure of having Mr. Singh here, who comes from an insurance background. So the issue which we want to debate here is, does insurance play a role in raising money? Does Indian companies have adequate insurance covers in terms of it may be a key man insurance cover, or you have sectors like real estate where absence of products like title insurance is actually is not giving enough courage or satisfaction to the investors to come and invest in companies here. So can insurance or having better insurance products assist or help in companies raising money?
Definitely, Sumesh. Insurance does help in raising money. Globally, what we've seen is there are various product and process innovations in the insurance world, and the banking and insurance sectors are converging, so to speak, because the underlying risk management philosophy is the same, and the rules and the metrics to measure, quantify and transfer risk are more or less the same. Even when you come to a project risk, there is a project risk on the lender's balance sheet, which can be transferred onto an insurance company by insurance wrapper. So globally, we've seen that collateralized debt obligations are a large way of raising large capital in the global market today. You know, people say that subprime was born out of CDOs, but I would beg to differ. You know, it's an instrument, how you use it is another challenge. So collateralized debt obligations can create a lot of cash flows, because what you're really doing is you're underwriting the cash flows of the future, discounting them into the present and funding them. Instead of looking at the past balance sheet and the past promoter record, looking at the collateral and the security cover, asset-backed security cover to fund those projects, which is the typical case in the Indian scenario today. So insurance covers typically product innovation, that is what is needed, both in the credit insurance, the political risk insurance, and also the title insurance, as you mentioned, because fundamentally all projects, whether they're infrastructure or real estate projects, are built on land, and if titles are unclear, we will have problems in terms of litigation and delays in project execution. More than that, the standard plain vanilla property and casualty covers are there. So Keyman insurance is a part of the casualty cover. The property insurance covers typically the fire, the earthquake, and the allied risk, allied perils. So typically, it transfers the risk from a promoter to that of the balance sheet of a large insurer who specialized in terms of measuring, quantifying, and transferring risk, and has the adequate capital on his balance sheet to transfer those risks to him. So process innovation, product innovation, that is what is needed in the insurance sector. And my take is CDOs, as and when they come into the India with monolines coming into the title insurance and the credit insurance space, we will have a large way of funding risk and capital in the infrastructure sector in India.
So Anup, in your experience, have you ever come across, as Mr. Singh is saying, transactions or cases where insurance been a hindrance, or investors been looking for more adequate insurance covers, which hinders or been a reason for delay in raising money?
I'm presently advising a HR tech company, and in the process of due diligence, and this is just in the debt financing area.
Yeah.
They definitely want to ask a lot of questions around your technology platform. Where is the data centers? Are your servers insured? What if all your clients, crash on a particular day and you can't, your uptime suffers, and that's the basis of your service. So some of these, questions are very real. So are you insured against business losses? Because if you're a services company and you're taking, revenues on annuity basis, on a monthly basis from your clients, and suddenly your backbone is on downtime, then you can really have a big business risk, and the revenues can disappear, clients can refuse to pay. And therefore, there is no revenue, and then there is no, capital available for you, right, from a financing basis. So therefore, that's a real risk. Those are questions that every firm has to answer, and certainly in the case of infrastructure companies, yeah.
Yeah. So coming back to you, sorry.
On insurance side, yeah, as Mr. Singh Anup told, that insurance is one of the requirement for these businesses, and even we have seen that for our sector, infrastructure, because we are 70-30 or 80-20 funded by the bank, so they need all kind of insurance for our products. But only one point I like to add, in renewable, we have seen that for our renewable sector, because it's a 25-year PPA, and we have to give the guarantee for 25 years for the product which we are installing on the farm. So there is no policy available in the market at this stage, though our teams are working on that and finding that we can have some policy available in the market. But that policy, non-availability of that policy is again a concern for the either investor, either client, that how and for the EPC contractor as well, how the guarantee will be provided for the performance of those. So those insurance, if certainly in the market, will be helpful for the investor, for the raising of funds, giving the confidence to the investor and the client to proceed with those projects.
So yes, so I think with all the panels we can agree, like of course, insurance, having more insurance products and can go a long way in protecting investors' confidence and boosting the investment. So relating to insurance now, moving on to the next question is, in view of the panelists, has the government taken enough sufficient initiatives for promoting fundraise? Because although we have banks traditionally, most of the PSU government banks giving debt financing, which obviously do not cater to a segment of SMEs or startups. Obviously, they only do asset-based lending. You know, all the debt financing happens against the assets. So has government taken enough initiatives or provides, apart from obviously we have a whole set of PE and VC fundraising happening, but does government in any way assist or provides any initiative for smaller companies to raise money?
Can you switch off the video? I don't want this to be put up on YouTube. Well, look, the government is making all the right noises, right? They are saying that we support all this digital India, startup India, etc. All the noises are coming, but there is still no structured platform which an entrepreneur, a person who is dreaming of setting up their own company or has set up their own company, running it for 3 years, therefore qualifies as a startup, is looking for, growth capital, not seed capital. I agree, seed capital comes from people who, trust you and they're known to you. There is no platform where you can go and approach for this capital. So the intent is there, but the impact is missing because the mechanism is missing. There is no mechanism over there. Recently, SEBI came up with a guideline on some of the crowdfunding networks, like you might know Let's Venture and some of the other crowdfunding networks, and there was complete confusion as to what's going to happen. Should you be part of a crowdfunding network or not part of that? What will happen to your capital gains? Up till what amount can you invest on angel networks? There was a restriction. So things are far simpler in other parts of the world, and which is why many even Indian entrepreneurs who have dreams, they will rather approach platforms which are based overseas. They will list their companies overseas. Even Flipkart went and listed its company overseas, the holding companies overseas. So therefore there has to be more effort on the ground, and that I think is the missing part, not the intent.
No, point well taken. Mr. Singh, your
I think the government can only create an ecosystem for capital flows to come in. So what we've really seen is a large amount of portfolio investments into India. We haven't really seen FDIs, what are really needed to drive the manufacturing in the services sector in a large way, both at startup and growth capital stage, through the private equity and the venture capital fund industry.
going to feel government.
Of course, there are initiatives needed from a fiscal point of view. Tax incentives are needed, tax hedges are needed from a government point of view. Because if you promote capital mobility, capital comes easy, and we are, whether we like it or not, we are a labor-rich economy from a factor endowment perspective, and a capital-scarce economy, and capital is mobile today. So, we know that a dollar trades at 67 or a pound trades at 80 or 100. So 1 pound coming into our market has a multiplier effect on the financial markets. And more than that, capital has technology embedded into it. So when we promote FDI into our country, what we really need is ease of doing business at the end of the day, whether it is regulations or rules or policies, or it is ways and means of attracting capital. Ease of doing business is what really matters at the end of the day. And government is has a key role to promote that in India.
Paresh, as an infra, being part of an infra company, what would you be like a wish list? Would you like the government to be more proactive in providing easy financing?
Yeah, Sumesh, very right. In fact, being an infra company or otherwise also, like government is coming with the innovative ideas. Either it's a Make in India, Digital India, as referred by Anup. So these innovative ideas are good and giving a positive thought and move to the industry also. But its implementation is tough in India. Like there's still time required to perfectly implement the same on ground. Either it's like coming on the Make in India concepts, how the funding will come, FDI is coming in the same way or not, and whether the investor has the same confidence to do the business in India, that is the next question. So the government is coming with the ideas, and government is facilitating those foreign investor mainly, either in the form of FDI or ECB, coming with the guidelines so that they have the ease of doing business in India, changing the concepts of either arbitration act or dispute resolution and all those things. So that certainly are giving them some comfort and confidence, but time is there to make more changes in that. Coming on the infrastructure sector, yes, even I have heard I have read an article where our minister has given one figure of interest for the infrastructure sector, like for the survival of infrastructure sector and to facilitate and for the success of infrastructure sector, interest rate should not be more than 6-7%. But still we are paying 13-14%. So paying 13-14% and 6-7% is a double of the same rate where we can survive. So these are the few issues which needs to be implemented fast, and result should, according the result will come in the market.
So point well taken. I think so. Obviously, we can say the government's been taking a lot of initiatives, but still there's a long way to go before the government takes some more steps for providing easy financing. Because typically, as you see in more developed economies, you can raise money at 3%, 4%, but vis-a-vis 11 or 12% interest rates. Is interest rates one of the key reasons companies unable to raise money, or because even when we see, because the debt financing rates are very high, so even the P or the VC funds typically want a ROI of which is something similar to a debt financing rates. You think with a fall in debt financing rates, even a ROI expectations of the P or VC funds will also have a impact?
Sorry,
So question is, in case the government would reduce the debt financing rates, would that have some impact in PVC funds being more realistic with the ROIs?
well, look, the interest rates now with demonetization are going to
Yeah,
go down.
obviously we'll
It's
come to
coming in the
that.
papers.
Yeah.
Obviously, lower the cost of capital,
Yeah.
the more it is beneficial for the entrepreneurs and promoters to access capital and to be able to return, and repay that capital back to their lenders, and that will definitely have a positive effect on the economy. Yes, the process of lending and borrowing itself is quite complex. It may take anything from 3 to 6 months. I mean, I'm being optimistic. But equity has to necessarily come in through the private equity, and because they are earning 1.5 to 2% or 0% in some cases with LPs, pension funds, etc. in the US and some of these markets where the rates are very low. So they have no other choice but to put a part of their portfolio here in emerging markets to be able to earn 15 times or 10 times that amount, and that's really the driver for that.
But isn't there very high ROIs for 15 to 20% driving lot of companies away from raising money?
No, companies they look for companies with breakthrough ideas in their own evaluation and judgment. So a company like Ola or a company like Flipkart will get a huge amount of funding from such players. But we also know that all the entire part of the portfolio doesn't deliver 15x. It will be only 20 to 30% of the portfolio which will deliver that. But you're anyway getting better returns than all the interest rates that you can get over there. On the infrastructure side, I was surprised, and I can share this with the audience. Today you can take your salary slip, right? And you can approach a bank in Singapore, raise, debt, a mortgage debt at 3.5% or even lower, between 2.5 to 3%, buy a commercial property, fully in, as they call it, white. And the Singapore government, look at how they have, catalyzed this entire space. There is no stamp duty. After 3 years, if you sell it, there is no capital gains. Why will the funds not flow in their direction? Why will anybody want to invest money in property in India when the mortgage rates, are so much higher than the capital values on rent that you're getting?
That is true. That is exactly what I meant by ease of doing business.
Yeah.
Transactional, both transactional and structural, because that is what gives the country risk perception to the overseas investor as well as the domestic investor. If you have a 8% stamp duty and there is an aversion of duty, and if you have a 40-45% tax rate and there is an aversion to create black money, even demonetization cannot help, because ultimately the big fish you'll never catch. They'll run away.
But obviously a drop in interest rates will go a long way in...
No, drop in interest rate is only possible if capital is plenty.
Yeah.
So for that, capital mobility is needed. You need to break the shackles and let capital come in a large way. Secondly, the inflation rate has to go down. So the interest rate is always a spread. Real interest rate is a spread over the borrowing and the lending rates. The spread is between the inflation rate and the real interest rate. So once the inflation rate goes down, the interest rate has to go down.
Right. Mr. Parvesh, as
Coming on this interest rate, no doubt if interest rate is on the lower side in India, that will certainly help for our kinds of industries, like for the infrastructure, because if we are paying 12%, 30%, it's hitting our projects. Recently we have seen in renewable sector where where the tariff has gone. I remember in 2010 the tariff was around 15 rupees per unit, which we were supplying to the government. Now the tariff has come down to 4.5 rupees. So when 2015, when the first tariff came down to around 5 rupees, Sky Power was the company which was a big hue in the market. Like how they have reached to 5 rupees in the market, where person cannot survive on that rate. But the time came when it reached down to 4 rupees 34 paisa also. Bharti Soft Bank has bid it around 4 rupees 4 rupees 50 paisa around. So the question is like how one is going to survive on these kind of projects. One is equity funding and the other is the debt funding. So if the companies are coming with their funding from outside India, so their interest rate is coming around 6-7%, 8% maximum with the hedge funding and all those. But where we are paying 12%, 30%, 40% in the market, and not at this stage. Like if we are good in EPC and we want to do the EPC, or we want to do the small projects of solar also, but my parent company is a big hit from the banking side, so bankers are not supporting us for that 14% also, because because banks have their own mandate from the RBI. So if the interest rate comes down and gives some parity with the foreign funding ECBs, and or the funds will be available to the infrastructure, specifically mentioning that it's a special lending sector, then certainly will help to develop the infrastructure sector. Like my only aim to convey here is that infrastructure is required in India and we are lacking in that sector. So government should come with some policies and ease for this sector, so that, and control also, no doubt government should have their control if the public fund is inflowing in this sector, so that we could reach a level of developing the infrastructure in our country.
Can I add something to this?
Yeah, please.
Yeah, please.
You see, we haven't really explored funding options as they are universally known. What exactly is interest rate, if we may ask? Interest rate is nothing but a mechanism which creates an intertemporal and an interpersonal transfer of value. So value is both which is stored in money or in financial assets or in physical assets, and also which is giving utility to the individual. So value is being created and appropriated worldwide, and we see more of value creation in our part of the world than value appropriation which is happening in the West. But what really matters is what is capital at the end of the day. Capital is nothing but stored up labor. You know, if we look at the West, they've made progress in the past, they've stored up labor in terms of physical and financial assets and the infrastructure that they've created, and that is mobile in terms of the monetary flows which are coming into our economy. That is real purchasing power at the end of the day. So what really I mean to say is that if we create structures where instead of the conventional 80-20 or a 30-70 debt equity ratio structure for funding infrastructure, we have something like funding on a non-recourse basis, on a collateralized debt obligation structure, where we have a preferred equity or a subordinate debt or a mezzanine structure created. All that the investor wants is return on capital. So it doesn't matter at the end of the day whether it is equity or debt. What he really needs is normal risk adjusted return on capital. First thing is reduce the risk of doing business in India, which is the country risk and the project risk. Obviously, when these two things happen, the return expectation goes down. And since capital is mobile, what really happens is with creating insurance wrapper structures where the project risk is financed and insured, you can actually reduce the cost of capital, both in India as it has happened overseas on a CDO platform with insurance wrappers and funding on a non-recourse basis for infrastructure projects.
No, point well taken. So as you're saying, obviously, you know, a reduction in interest rates and creating an environment against it can give a big boost to the economy. So I think then coming to, yeah, you want to say something?
That is true. That is definitely true. And I think the demonetization effect in the long run is going to help because the black and the white economies are going to merge. So the current problems we had, you know, where the monetary policy transmission was not happening, the RBI was trying to reduce rates and it was not impacted into the cash flows or the baseline asset inflation, that will help in long run. Of course, there will be pain points in the short run, but we have to live with that once the policy has come into being.
So coming to demonetization, you know, there are very divergent views. So one set of views is obviously with all the money coming into the banks, there gonna be a lowering of interest rates and economy is gonna revive. But on other hand, the real situation is where a lot of companies are seeing a huge loss of revenues and loss of profits, as there is quite a slowdown where you're seeing lot of the sales have come down. Every company's rollback its projections. So, what is your take, Anup? What does have an impact on the financial sector? Would it be give a boost to the economy in terms of lowering of interest rate, with bank being flush with funds, or is gonna create a negative impact as lot of companies, due to some reasons, are seeing a quite a lower revenues, lower sales, which may have a negative impact of dampening the economy and giving it a revive.
Well, this is not a straight question to answer, very, very difficult. Because there are many moving parts in this, and we'll see how it pans out. So, and I'm not an expert, but I'll just try and give my point of
So,
view.
any of you, so the
Yeah.
question is, what do you feel?
Yeah.
Would the, would demonetization give a positive view, or would it assist revive the economy, or would it further take the economy into a bigger plunge? As the
No,
companies
no.
are also looking to
Yeah,
a
yeah.
slowdown. We are
Okay,
seeing
yeah.
overall slowdown.
Yeah, look, the slowdown is real. So slowdown is real, but it's going to happen for, I think, 2 quarters. And the reason why I'm saying that is this is a preparation for cleaning up the system. Why? Because on the 1st of April, hopefully, I hope it goes through, is you've got GST coming. Today, let me tell you what happens in the FMCG trade. Everybody understands FMCG? Yeah, consumer goods. So there is, material which is shipped from the factory, and it is excise paid and VAT paid, and it travels to the wholesaler. The wholesaler sells, let's say, 20 crores worth of goods, but says my income is only 18 crores because I only collected it. There is no trace and no data matching, which happens in all developed markets, where you can straight away say that, hey, you purchased goods worth 20 crores, you must have sold 20 crores, otherwise you must be having 2 crores left in the go down. So there is nobody checking that, and therefore that starts the cycle of black money. Yeah, because there are many loops in the chain, and wholesalers down to city distributors, area distributors, and the escaping of tax starts, and this whole money is circulating in the economy. Now that model is disturbed, and that is why the current consumer sector is in a bit of a pain for 2 quarters. And even at the front end, the small petty grocer and your salon person and everybody else who's servicing us, whether for a haircut or whether for supplying us medicines, nobody declares their real income. They'll purchase goods worth 20 crores, they will say I only sold 15 crores, but they don't have 5 crores of stock in there, and they have much less than that. So therein starts the virtuous cycle. You are going to see money coming into the banks. The lending rates are going to go down. That is a boost for businesses, especially boost for businesses which are real and which have fully accounted, and they do business by the ethics, right? People who are not doing business by the ethics, they are in trouble, and they are going to take at least 2 quarters to become legitimate, because guess what? If you don't have stock, then you better have cash. If you're going to have cash, that cash has become illegal tender. You have to go and deposit it in the account. Otherwise, you can't use it. Otherwise, you can burn it and forget about it, right? And that is also good for the economy. So all that stuff is going to take time. New models are going to come up, right? And the companies are inventing, by the way, and I'm privy to some of the stuff that is going on to reach to the consumers, because companies are not going to let their businesses go down. They were forced to deal with these people who were not operating business by the ethics. So overall, I think it's going to be a perfect shot for the economy. Yeah,
It's gonna be a. Singh, your views?
I think I would agree to that. We have a large informal sector, so-called informal sector in India. Probably we have something like 60% of the population depending upon agriculture, which is not taxed. So, the source of black money is not just creating value, but also appropriating value and consuming value. So, in the entire supply chain, we would see disruption both in agriculture and industrial and services supply chains in the next 6 months. It is going to be disastrous if we don't manage it well, because supply chain constraints are there and breakages are there and bottlenecks are there. But once we clean up the system and the GST is into place, it is a win-win scenario for all of us. But more than that, what really happens is the interest rate today does not reflect an intertemporal and an interpersonal transfer of value or transfer of wealth. And wealth in any inflationary economy like ours has always been hoarded either in gold or in physical assets, because of the inflation, rupee loses value. If there is a 10% inflation, there is a 10% loss of purchasing power every year. And there is 90% informal sector in India, which will again integrate into the formal economy once Jandan accounts are integrated into zero frills to all frills accounts.
So you feel it will not lead to much, reduction of interest rates?
No, it will definitely. Interest rate will change. There will be loss of, if people say that there will be 2% loss of GDP, it is there. It is real.
Yeah.
There is. You can't wish it away. You may have a financial gain in terms of the money coming into the balance sheet and getting accounted for. So that's an accounting entry gain, but there is going to be real losses. But these in the long run, say the next 3 to 5 years are going to be, look like a temporary blip in the overall economy of the country.
Absolutely. Right.
Yeah, in fact, Reddy said, my only view on this is that demonetization probably it had different phases in the economy. Now the general man is saying that only except being queue, there is no other problems faced by them. But time will come, like not only 2 quarters, probably it will take 2 years to come into the stage that the small shopkeepers all will start showing their income in through banking channel. So I remember a few years back, quite 15, 20 years back, there was one, I was in touch with the small shopkeepers, those who were not filing their return. So they have been given the option to file their return. So the first apprehension to file their return, and no question will be asked from them whether they have their profit in the last few years or not. So there were discussion with the small shopkeepers that what will happen if we file return this year and not in the future years, or once connecting with the income tax department will probably keep us in trouble for the future things. So that apprehension are still in their mind after 2 quarters, 3 quarters with the small shopkeepers, small markets will have that apprehension in their mind that what is going to happen when they are keeping everything in through banking channel. So it will take some time. There is a there will be slow economy during this period, but definitely it will, in the long run, it will help the economy, and we will get the benefit of this process. Yeah.
No, thanks for your view. So that's very interesting. So I think everyone's in consensus that, demonetization is going to help, and there might be a bit of slowdown, but overall you're going to see give a boost to economy as interest rates going to come down. So coming to the last question of our to the panelists is, as the theme is key challenges faced by the company. So what, in your view, would you give in as suggestions that what steps can be taken to, or by the government, or to make it more easier or accessible for companies to raise money, because how the challenges can be reduced?
So I would say, I think I said it earlier, which is create a platform, okay, and various people who want to lend capital or want to invest capital, they should list themselves, right? And people who want to borrow or who want to get invested in, they should come and list themselves over there and have platforms, a platform, let's say, of this nature, where you come in, you have people of both sides present, and you have an institutional way where you can go and pitch your business. Otherwise, it sounds very parochial, but today's investing environment is mostly led by old boys networks. So if you belong to the top tier colleges and schools in the country, there is an informal network. So we are all part of that network, and that's how funding goes. You know someone who knows someone, and that's how believability in the business plan is generated.
That is true. I will endorse that. Whether it is in India or the UK, I've come across the same perception and the reaction. Yep. I have done cold calling. I've done emailing on the British Venture Capital Association databases and Indian Venture Capital Association databases. Talked to VCs through my network and informally, but reached a dead end. And the reality is, seed funds are hard to find. Earlier, in the earlier age, prior to demonetization, there was a large informal sources of capital which have dried up now. So we had a large amount of informal sources of capital where investments were occurring. So-called Lala investors who were looking at getting white returns, but all that will vanish. What is really needed, as you said, is a demand and supply meeting together in a marketplace. Whether it's an electronic marketplace or a physical eyeball-to-eyeball marketplace, it is needed. And it needs to be a regulated market, so to speak, because the ethics of the trade need to be defined, the intermediaries as well as the banks, and the barriers to entry need to be relaxed. More banks needed, more the merrier, more borrowers needed, and more lenders needed, and more intermediaries needed, and regulation and prudential regulation from a legal perspective is needed.
Absolutely.
Let me give an example.
Yeah,
sure. For example, in Australia, and I think it's there in the UK as well, if you're a landlord and you're giving your house on rent, right, the deposit that is given by the tenant is, and the agreement, even the format of it, is with the rental tribunal. The deposit here in our country is with the landlord. If both parties on either side, yeah, they are respecting a third party, which is, which is completely objective and has framed all the rules. You have deposited your money over here as a security for returning when you leave as a tenant, and the landlord is also happy because the laws are pretty strict. They will throw the tenant out if you're not respecting the rules, and everybody binds by that. That's the way to conduct. That's how you ease and avoid business. Otherwise, there's always private, all of this stuff, and then there's litigation, and then all of that. Where is the ease?
I think certainly I agree with you on this. What we really need is rules of the game defined. Contract certainty is needed, which we don't have in our country. You see, that is what creates ease of doing business. From a legal perspective, laws of the land need to be respected, and laws of the land need to be created in a manner where they're structured in a manner where they're enforceable, and not just delays and gaps in the laws are there. So what really happens with this is that the risk perception goes down from a lender's perspective, and also the return on capital expectation goes down. So when you talk about reducing the cost of capital or the interest rate, both these help in a long way. That's where lawyers will play a major role in creating an ecosystem and an infrastructure where contract certainty exists and is created in our country.
True. Sorry.
Yeah, right. In fact, the same thing came again, the ease of doing business. That is the main requirement. Like this government is working hard on this, and our ranking has changed in a big way. Yeah, enforceability of contract is the point where Mr. Singh has referred. So this was the lacking part in our country. So now we are finding that even our discussion with our counterparts in other countries, so they find it difficult to enforce the contracts in India. And secondly, like recent example we have faced in our organization, like sometimes government organization knowingly that some of the contracts are not drafted well, or it requires changes, but treating it as a favor to the third party, they don't take any calls, and you have to approach the court, and sometimes approaching the court takes a long time to get any decision. So till that time your projects are on halt, or you are unable to proceed with that.
But anything you would like to conclude or say that any steps that will help in easing the financial or the finances for infra companies or companies in general, like some steps that government should take in terms of maybe having better tax incentives for investors coming in, or having lower, because typically we've been seeing a lot of VC funds have been facing harrowing times when they are looking to their capital gains are taxed at very high rates. So anything in your view where you feel that investors can be given some more incentives to invest, and what would you like as a company to see? Yeah.
So from our side, like the one point I would like to add here is that there should be easy exit scheme for the investor. Like if they are coming, they should not think that their money is blocked in India. Either they are coming as equity or the debt. Like if we go with the FDI or ECB, so the scheme should be, regulation should be in such a manner that they should feel comfort that whenever they want to exit, they can get their money. Like earlier referred that it's difficult to get the company listed in India because we have to follow so many regulations under ICDR. So we cannot do that. Yeah. So that's the only point we'll like.
Take away last.
I think in addition to the regulatory framework, what is really needed is the intent to absorb and create capacities to absorb capital. Trust me, if I bring in $1 billion into the real estate sector today, there is no absorptive capacity. Unlike in a Dubai where I can pump in $1 billion and get away with it in a week's time, I do not have physical or financial assets to absorb that kind of capital flows into India. So what is really needed is creating an ecosystem where we have the banks, the financial institutions, the companies all integrated into an ecosystem where large flows of capital can be absorbed in a labor rich economy. And trust me, a 10% growth rate is just a firmament of our imagination. What we can achieve is higher growth rates, because growth is nothing but increasing your GDP, and that is nothing but more of guns and butter that we are producing every day. So all that really needs is more of roti, kapda, makan and entertainment all rolled into one. And as you go to the bottom of the pyramid, the more the growth expectation, the more the challenges and more the capital flows, it's easy to hit the target growth rates that we really want. It's just a firmament of our imagination, the growth rates that we have in India today.
True. Any final takeaways from you? No.
I think one of the things that the government could do is make a sort of framework so that everybody doesn't have to employ expensive lawyers. sorry for that, and frame their own agreements. So, you have that, third party.
That I'm sure won't
Standard.
help in any ease of business.
The second thing is, I think, provide financial incentives, for taking risk. So if you are a VC and if you're taking risk, then the capital gain tax for you should be different from that person who is investing in a listed company, right? It can't be the same. It can't be long-term capital gain for everybody is 20%. So that should be different. Similarly, for an entrepreneur, if you're starting a company today and you're taking that risk, and if you're having a partial exit in 3 years' time, why should your capital gain be the same as somebody who invested in a mutual fund? It doesn't make sense. So that reward should be there.
Yeah. So I think we can conclude by saying, obviously there's no one reason. So a country needs a mix of a better ecosystem, better tax incentives, and lower tax rates. In case we want to make it more attractive for companies to raise money and reduce the challenges for companies to raise money. Now I throw the floor open for questions from the audience. Yeah.
There is one question and one observation.
Yeah, please.
So the question is, do you think this demonetization effect will bring a big reform in terms of getting rid of NPA problem, as banks have started writing off the bad debts, and this will help banks to lend fresh money, and this will increase the GDP growth to 10%. And the observation from Mr. Anup is that there is a Startup India Hub which has been started by DIPP, and the role of Startup India Hub is to set up that platform, and I would like to announce that that platform has already been set up under Invest India, which is one of the supporting partners, and we have been assisting in getting funds for startups. For example, last month only we have got one electronics company to get a startup fund from Electronic Development Fund. So that platform has already started.
No, point well taken. But on the, yeah.
Well, one swallow does not make winter. That's what I'll say. What we really need is an ecosystem and large ability to absorb capital flows. As I said, capital is nothing but embedded technology into cash flows and stored up labor. If somebody has made progress in the past, let us not reinvent the wheel and buy technology from them rather than trying to recreate it at our end.
True. And answering your question on demonetization, yes, with so much flush funding coming into the banks, we are sure that the interest rates gonna fall, and obviously the banks gonna do a lot of bank would have no options but to do some fresh lending and probably at much lower rates. So surely that's quite foresighted for all the banks, because the real reason, the real problem which we been now the banks are facing is different. They're saying there is very little cash withdrawal, but obviously with the limits coming in, and there's so much of deposits, so banks are surely flush with money. So you will obviously in the coming few weeks and next year you will see a lot of fresh lending happening.
I think more than that, the banking philosophy has to change in India, because banks in India are like typical money lenders who lend against a collateral security. They don't take risks on the projects that we are talking about. So that's the philosophy we are talking about in the days to come, where the future cash flows are in, we create risk structures through insurance platforms, and we insure the cash flows and, fund projects based on future cash flows rather than the past performance of the entrepreneurs.
You have a question? Mike.
Though due to demonetization, interest rates are going to come down, but the valuation of land is also falling, like 50-60%. So we hear your point that banks are they give funding only on the collateral. So
Land is a dead resource, as is gold. Yeah. Unless you create a building on top of the land, trust me, it has no meaning. Unfortunately, even a company like DLF has been talking about land banks, and in the process created 19,000 crores rupees of debt liabilities on their books, which they are finding hard to service. So an IPO which came at 800 rupees or 850 rupees is today trading at 200 rupees. Look at the valuation or the loss of value we have created in the real estate sector in India. Trust me, we have to move into a paradigm where it is housing for all, affordable housing, and housing created at the bottom of the pyramid rather than the luxury housing that other companies and real estate developers have done. To do that, you need title insurance in India, because the underlying risk structure on the title or the legal title ownership is not clear. And that is where we'll need a lot of legal acumen and lawyers to help us create a title insurance framework for India. Because according to McKinsey, 90% of the titles are, grey or defective in India. It may not be 90%, but trust me, it's a large number even today. I sit on the working group created by the IRDA for title insurance in India. So we are in the process of creating a report for title insurance in India. And initially it's going to be a reinsurance driven product, but trust me, we'll need a large number of due diligence companies from lawyers to create it for title due diligence. And this is going to be a large business in India as it is in the world outside India, because what you really need is regulated entities who deliver credible and believable reports for diligence of the titles, and that is the premise or the basis of underwriting title insurance in India. And if there is value in land or buildings on top of that, right, value has to come from the rental returns that you generate and not the capital values through scarcity of assets in India as it is. So breaking down the bottlenecks is important. Just cut the bottlenecks, supply side constraints and bottlenecks, and it gets into an integrated marketplace.
Banks don't take risks. Vijay Mallya's story doesn't seem to say that, right?
I beg your pardon?
Vijay Mallya's story doesn't seem to say, look,
It is a case of fraud. It's a case of fraud.
So banks take risk at a cost, you're saying?
No, it is a fraud. It is a case of banking fraud.
No, but the collateral was his the brand, which is zero value today.
No, I'm sorry.
Even his real estate value is nothing. Nobody's buying it.
So Mr. Singh is right. It's a case of fraud. Why did a bank lend on a brand? Can I go to a bank and say, I run my law firm, that please give me 1,000 crores on my brand? A bank would not allow this. So somewhere some banker permitted Vijay Mallya to, raise thousands of crores only on his brand name and not on collateral. So it's not obviously a case of someone being entrepreneur enough to give him a risk. It wasn't a risk appetite. I think it was a case of a fraudulent activity.
Sir, it is not some bank, a consortium of banks led by one of the largest national banks.
So that's where I said, just unshackle the banking industry. You don't need the RBI giving licenses like they give 1 or 2 licenses. Give hundreds of licenses. It doesn't matter. If in the US there are 6,500 insurance companies, if there are 1,400 title insurance companies in the US, why can't we have more than that in India? It's a larger country and a larger economy. At least the growth potential is larger. Trust me, barriers to entry have to go. It has to be a competitive environment.
Scheme in Indonesia the same time that we had in India. I don't know many of us know about it or not. And a lot of Indonesian money is parked in Singapore, etc. Look at the culture that we have, okay, and this is, to your question and the repartees that happened around fraud, etc. $34 billion came back into Indonesian banking system under the voluntary disclosure scheme, and it is still continuing. Every week that you delay in terms of declaration, the tax that you have to pay goes up, right? You can look it up on the internet. In India, when we had the scheme which ended on September 30th, every day announcements are coming in the papers, everything is coming, $10 billion came. Look at the size of their economy, look at the size of our economy and the amount of, black money that's parked in the. So we are not, there is not a perfectly, there is information asymmetry, there is discretionary power being used when you're using lending. We know that there is corruption as well. Many of us, have faced it. So it is there. It is not a perfect world where things are taking, shape in the form of rules and everybody's following the laws. So I think, what Sarabjot is saying, I guess, is let it be born out of risk that a certain bank or a certain institution are willing to take based on, sound principles, not on the basis of discretionary power on a pool of money that you have come to own. So that is what happens in the case of, the public sector banks. I'm the chief general manager of, SBI in Connaught Place. I have 500 crores lying with me. I have the signing power to, give 100 crores to anybody I like. That is not the right way to do banking.
More than that, what you really need is a large capital on the bank's balance sheets, which we don't have. Typically, at the end of the day, if you look at capitalization of the banks, most of the banks and insurance companies in India are pygmy sized. I work in a company, Hannover, which is like $5 billion of equity capital, right? So on $5 billion, we do $18 billion of reinsurance business globally in 150 countries, and we make $1 billion of profit. So at the end of the day, when you write Risk, you need capital. Same happens in the banking. If you look at Basel II and Basel III norms, these are not money lending shops. These are institutions which have to take risks in the economy. And to do that, Basel II and Basel III need a capital adequacy ratio which is large and ever growing. We need to recapitalize the banking system. Trust me, every rupee that has gone into the Jan Dhan accounts and the other accounts are a liability of the bank, right? To increase the lending base, you need to inject capital into the banking system. And trust me, in a country which doesn't pay taxes, it is a tall order. It is a real tall order because there is no capital on the balance sheet. Yes, there is enough human capital. Yes, there is capital which is informal, but you need to get it into the formal structures.
Okay, here we end our panel. Thanks, everyone.